Today, I'm gonna be teaching my friend Tony how to trade options in the stock market.
Well, I didn't come to win or lose, I came to gamble. Let's mitigate risk and buy as many as we can.
We're gonna check back in at the end of this video to see if you end up making money or losing your entire account. Tony, are you excited for today?
Boy, am I.
Have you ever traded in your life before?
Kind of. I YOLO'd some money into Dogecoin back in the day.
Okay.
Made some off that and then put a down payment on a car and never touched trading again.
Really?
Yeah.
I didn't know that. That's crazy. Okay, so that was crypto. Today we're gonna be covering stock options, which is what I trade. So I wanna start by simulating what every beginner does when getting into the market, which is typically opening up Robinhood, funding their account with 500 bucks, which you just did, and then choosing a random stock and throwing their whole account on a random option contract. So I want you to open your phone, and this is before I actually teach you how to trade. My goal in this video by the end is to give you a simple yet effective trading strategy that you'll be able to apply moving forward. But I do want to show you what most people will do. So pull up any stock in mind.
Any stock in mind.
Do you have any stock you know of that you want to buy a contract on? And I know you might not even know what a contract is, but we're gonna cover the basics when it comes to options as well, so don't worry.
Let's go for something a little bit popular recently.
Okay, NVIDIA.
Yes.
So, do you know what option contracts are?
Kind of, in a way. I know you're betting on over/under, basically, flipping a coin, but that's as far as I know.
So you can buy what is called a call or what is called a put. A call essentially says you're betting on the direction of that stock to go up, and a put, you're saying you're betting on the direction of that stock to go down. So if you open up your app here on Robinhood and hit trade, you'll hit trade options, and now you're gonna decide, well, do you think NVIDIA is gonna go up or down?
It's a good question. There's a lot of options.
I'll show you, don't get overwhelmed. So first, choose an expiration date. You can see how it says today, July 26th, August 2nd, August 9th, August 16th. With options, you choose when that option contract is actually going to expire. So they have an expiration date, and that, I'm not gonna tell you, but that expiration date is either gonna make those contracts way safer or way riskier based off of what expiration date you choose.
Okay, something tells me today might be a little bit riskier.
It's up to you.
Which is exactly why I want to do it.
Okay, so you're gonna buy options that expire today, and do you wanna bet on NVIDIA going up or down?
Let's say it'll go up.
Up, okay, so you're gonna buy a call, and now you're presented with, you can see buy call, you're good. You're presented with a bunch of different option contracts. You can see you have the 120 calls, the 119 calls, the 118 calls. Now, that's called the strike price. There is what's called in the money and out of the money. So in the money, if you're buying a call, is gonna be anything below, okay, any of these contracts below the current share price. So it'll show you there. The share price is 119.52. Those are all gonna be in the money. Those are inherently, I'll tell you, safer. Now, anything above the current share price, 120 calls, 121 calls, those are called out of the money contracts, and they're gonna be riskier. They essentially have less value, whereas the ones in the money have more value. And then with puts, it's just the opposite. So you can go about choosing one of these contracts. The 121 calls, the 130s, whatever you would like. And I know that's all you know so far, but again, we're simulating what a beginner would do.
Well, I didn't come to win or lose, I came to gamble.
Oh God. So which contracts are you gonna buy?
Well, obviously I want to go a little riskier. Risk versus reward, right?
Okay.
Say 123 is a nice number.
Okay.
So we're just gonna...
So those costs, you can see right now, that is the current contract cost. So it's, when it comes to options, options are essentially leveraged 100 to 1. See how it says 0.05? That's not 5 cents, it's $5 because of the leverage. You can decide how many you want to buy. You have 500 bucks in your account.
500 bucks? I'd say let's mitigate risk and buy as many as we can.
Oh my God.
Oh, wait. Well, it looks like 99 is a good number.
It looks like that. So, it's funny, but this is what a lot of people do. Like, this, don't worry. Okay. This is very like common, but it's funny for me because I just know that. So you can hit review. Now, You got a day trading warning. What's this say?
It says, this contract expires today. If your position is closed during our sellout process, it'll count as a day trade.
Okay, so you can continue. Now, let's just look here. There's what's called a limit order and a market order. A market order is essentially you coming in saying, I'll pay whatever another seller wants to sell these contracts to me for. You're just okay with whatever price you get filled at virtually. So you can also go in with what is called a limit order. And a limit order, you're being specific and you're saying, hey, I only want to buy these contracts at this price. So right now you can see the limit price, we've got the bid and the ask. Right now your order is set at 0.05, but the bid here is 0.03. That's $3 and the ask is $4. So I want you to go to edit because we want to get the best fill price possible. I'm going to save you potentially 10 to 15% right now just by doing this. So you can see here, if you click, the bid is 0.03. Let's try to send in an order and get filled at $3. So you're going to type in 0.03 and now you can review and send that through and we'll see if we get filled because again, this is a limit order. And so you may or may not get filled. Max cost. So yeah, I mean, now it's only $300. So in theory, you could buy more than 99 if you could buy more than 99. Oh my God.
165, okay. 5 cents under.
So 165 contracts, let's send this through. Let's see if you can get filled, okay? Nice. So you're trying to buy 165 of these NVIDIA 123 calls, expiring today. Now, we're gonna see if this order gets filled. So we have to be patient.
What happened? Did I get them?
Nope, not yet.
Uh-oh.
So if you click on here, you can see the order is like working. So the bid is now 4 and 5, and you're trying to pay 3. So if you want, you can send another order through at 4, or we can wait.
Do I do replace order if I want to do that?
Well, you're bidding on NVIDIA going up. These contracts are going to go up in value if NVIDIA goes up. So you want NVIDIA to go down.
Oh.
So that's the only way really you're going to get filled. And this is very important actually when it comes to options. There's liquidity, more or less liquidity, right, behind the contracts. That just means more people are trading some contracts than other contracts. And if there's more people trading a set of contracts, there's more liquidity. There's more people to buy from and more people to sell to. If there's less liquidity and not a lot of people trading contracts, that would be referred to as having little volume or open interest. Well, you're gonna deal with essentially a larger spread. So between the bid and the ask, there's gonna be more space. So right now it's $1 between the bid and the ask, but those contracts are only $4 or $5. So in percentage, that's actually pretty significant. So that's a large spread.
I see bids down to $3.
It's down to $3.
You might be getting it.
There you go. So you're starting to understand how this works.
Yeah.
The bid and the ask, but you want to pay the least possible for the contracts, right? You don't want to overpay unless you're like really certain and you really just want to get in that order. So we're still waiting here and you might not get filled. That's the thing, you know? But typically you don't want to trade contracts with little volume, no open interest. You don't want to touch those because you could get stuck in trades where there's literally no one to actually buy those contracts from you. Does that make sense?
Yeah.
So I think we might want to go ahead for the sake of this video and just get in this position. So we might end up paying a little more. What do you think?
I'm fine with it.
Let's go replace order.
Replace order. And then are we going to bump it up to $4?
Yeah, so right now I think we could definitely get filled at 4, right?
All right.
So we would, essentially go in at ask. And so market orders, you could end up paying a lot more versus the limit order. So this is a very important lesson for you to learn right off the bat when it comes to options trading. All right, let's send it through.
Cool.
Order filled.
Nice.
Congratulations. Now we're gonna check back in at the end of this video to see if you end up making money or losing your entire account. All right?
All right, I'm excited.
All right, we'll check back in. All right, so now I'm gonna teach you what to actually do. I will say those were probably the riskiest contracts you could have bought.
What do you mean? I think they were fine, honestly.
But you just made that decision pretty much based off of intuition, right? You bought NVIDIA, you didn't really know, or you didn't have any tools or anything to tell you that it was more than likely gonna go up. Is that correct?
I had a feeling.
You just had a feeling, and most people just have a feeling. In this video by the end, I want you to hopefully come out of this without having a feeling but with having an actual strategy that you're confident in, that you can apply. So right now, what you're looking at on my screen is an actual chart with candlesticks. Before, you didn't look at a chart, you didn't look at anything, but now we can see a visual representation of, well, this stock specifically, W day, okay? So what we can see here are candles, each candle representing 4 hours of time. The black bars in the middle, those represent open market hours, and the gray is after hours and pre-market. So during this black bar, right, this is when we can actually trade options. You can't trade options after market or pre-market. So today, you could see the first 4 hour candle that has been formed today. You could see the wicks, these are called the wicks, and this is the body of the candle. Now, if we look at the bigger picture, the easiest way I could describe how I trade is I'm essentially a trend trader. What I want to do is I want to identify the overall trend. Within that trend, I look to trade patterns using a series of moving averages, is what I like to call reference points. So we're going to cover what moving averages are, what moving averages I use, what time frame I trade on, and then we're actually going to cover a setup, which is how I define all of the above. When I look at a chart, I have what are called setups, and I look for these setups on charts, and I have checklists for each setup. And when I can check all the boxes off, well, that is when I take a trade. Does that make sense? Mm-hmm. So what you can see here, again, we're looking at a 4 hour time frame, and we're looking back over the last 180 days. So the only active trading that's being done is about an hour looking for the stock, looking at the chart, identifying whether there is a setup there or not, and then putting on the trade and placing the trade. That's it. And then I kind of sit back and I wait and I let that trade play out over the course of a couple of days. So what we can see here is, well, let's pull up a different stock. I'm going to pull up a watch list here. Let's go through the S&P 500. You know what the S&P 500 is?
Yes.
So what we're going to do is we're going to go through all the stocks in S&P 500. We probably won't get through all 500. And we're first going to look to identify the trend. Now, there's two trends, either bullish or bearish. What is a bearish trend? Do you know? What does that mean?
One goes up, one goes down. Bullish.
Bullish
Up.
is up.
Bullish is up, bearish is down.
Yep, exactly. If you have any questions, just interrupt me.
Okay.
So we want to first identify what the trend is on the chart. So what is the trend here on Apple?
It's going up.
Bullish, great. Bottom left to top right is bullish. Okay, what about here?
Seems relatively bullish.
Relatively bullish. So some charts, it's harder to identify the trend. They could be very choppy, they could be trading sideways. I avoid charts that don't have a clear trend. What about this one?
Oh, beautifully bullish.
Really bullish. Now, the next thing we want to look at after we've identified the trend, well, I want to look to see a very clean and clear chart. Now, I talked about moving averages. Do you know what a moving average is?
No.
So moving average is essentially going to give us the easiest way I can explain it. When we look at a chart, we apply a moving average, we select a specific range of time, okay? It can be 1 day, it can be 100 or 200 days, and it's gonna give us the average price movement over that period of time. And it's gonna be represented by a line on the chart.
Is that the green line?
Yes, so that's the green line, the red line, and the blue line. So the green line is actually called the 180-day SMA. There's SMAs and EMAs, simple moving averages in SMA, and exponential moving averages in EMA. You can see on my trading platform here, simple moving average, and moving average exponential. So we've got one SMA here, which is the 180-day. We've got another SMA here, which is the 50-day. And we've got an EMA here, which is the 15-day. So we're gonna use these moving averages as, like I said, reference points to, well, determine if there's a setup there or not. But mainly, we're gonna use these moving averages to actually determine if we do take a trade, where we're gonna be right and where we're gonna be wrong. Now that you know what moving averages are, well, we are gonna look to see if moving averages are what I like to call respected or not respected.
Is it if they all line up or if they don't line up?
So not necessarily line up, but what we wanna see is that candlesticks, you can see the red and the green 4-hour candles. We wanna see that they're not trading on top of a line, one of these moving averages, right? We wanna see that they're either trading above or below. Yeah, it's fine if they, slightly break through one of these moving averages and end up pulling back above. But overall, we want to see that they are respecting, treating one of these moving averages as either a support or a resistance level. So if candles are trading above a moving average, for example, the 15-day, that means the 15-day is acting as support. And if they're trading below the 15-day, that means the 15-day is acting as resistance. So we could find some examples, but the cleaner and the clearer the chart, the better, okay? This one is pretty choppy, but what we wanna see is that over the last 15 days, the 15-day EMA has been respected. Over the last 50 days, the 50-day SMA has been respected. And over the last 180 days, the 180-day SMA has been respected. There will be what I call retracements and remounts, where the market will test an area. It'll test the 180-day SMA as support because the candles were trading above. You can see we did break below support, but we ended up remounting, okay? And that is very common. You'll see that a lot of beginner traders will set their stop loss where they're wrong, right on a moving average. And the market will pretty much take them out of the trade, take their money, and then it'll come right back up, okay? So that's something you should note for further down the line. Okay, when we go to actually decide where we're right and where we're wrong. But what we want to identify, one, obviously the trend, two, are moving averages respected or not? And are they respected based off of that given time frame, right? So we can see the 15-day here. If we count back 15 days, right? Generally, you could see that overall, the 15-day has been respected.
Would that mean you put in a 15-day call?
No. Don't worry. I think it'll make more sense in a minute here. Okay, so this is what I call the ATH or all-time high pullback. This is one of the setups that I like to trade, and it's very easy to explain. Now, you can see our entry criteria. Overall trend is bullish, right? We know that. Next, we want to see a chart that's sitting slightly at or slightly below its all-time high. So you can see a high, okay, 851.88. That is an all-time high on the 4-hour time frame looking over the last 180 days. So we want to find a chart, again, that's sitting slightly at or slightly below. We want to see that all-time high has just been formed, okay? Not looking at an all-time high that's been formed, back here. We want to see that all-time high was just formed and we're sitting right around that all-time high. Okay, looking at our candles, looking at where we're trading, we want to see, that this stock is trading around that all-time high. Simple. The 15-day EMA currently respected, okay? And then the 50-day SMA currently respected. So I want to pass this over to you. So again, overall trend.
That's the 180-day.
Yeah, we don't need to look at the 180-day, but we want to make sure the overall trend is bullish.
Nasty, disgusting, ugly. I hate it. Get it out of my view. Horrible, disgusting, awful. You had me in the first half. Don't like where it's at.
Okay, wait, what is this?
Oh, this is
I like this. Okay, let's move on to trade management. We have 4 different options to trade this chart. We can essentially trade a break below the 15-day EMA and short to the 50. We can short off the all-time high down to the 15. We can short off the all-time high down to the 50, or we can play a break below the 15 and 50 and short to an area of support. What do you think here? And I'll show you how we're actually gonna decide which moving average makes the most sense, or I would say is the most realistic to look to play a move into, or down to in this case.
I'd think down to the 15. I mean, we got that huge spike that just happened right there, and it's been consistently, relocating down to the 15-day.
Okay, exactly.
Over a period of time.
Over a period of time, the overall pattern, pushes into new all-time highs and pullbacks to the 15-day. So here's how we see if this is a realistic trade or not. I created this little tool, okay? I call it the ADR calculator. You can see up here the average daily range. We're looking at 2 different kind of measurements. We've got the average daily range over the last 180 days, and then we've got the 3-day projected movement. 3-day projected move because my average hold period is 3 days, so I have it default set to 3 days. I'll put this link in the description of this video and I'll give it to you. You can download this tool on your Thinkorswim and use this. Okay, so what we're gonna do, we're gonna pull up the drawing tool. Now we are going to essentially go chart the actual percentage off of the 15-day first and then the 50-day. We're gonna try to see how far we're currently trading off of each moving average. So let's just drag down to the 15-day, and you can see we're sitting 3.36% off of that moving average. Let's drag down to the 50-day. You can see we're sitting about 6% off of that moving average. If our average hold period is 3 days, we can see that 3-day projected movement is 2.81%. So we want to see that we are within 2.81% off of one of these moving averages, if that's a realistic trade, right? So let's drag down 3.60. Do you think that is a realistic move to hit within the next 3 days based off of the average movement?
Yes.
Sure?
No.
So here, over the last 180 days, on average, CTAS moves about 1%, okay, 0.94. Over the next 3 days, it's projected to move on average. That's not up or down. That's just daily high, daily low, about 2.81%. We are sitting over 3% off of the 15-day, which is above 2.81. It's more than 2.81. We're sitting over 2.81% off of the 15-day. So I don't think that is a realistic target.
Too risky.
It's not that it's too risky. It's that when it comes time for us to correctly choose the right option contracts, then we're not going to be able to make correct or accurate projections. Now, let's say, because we would be here all day to cover everything that is in the masterclass, but let's just say our average hold period instead of 3 days is 5 days. So we can go and adjust that. Now, in this case, look at our 5-day projected move is 4.68%. Now, if we chart down, we are sitting 3.61%, which is within that 4.64, okay? 3.59% is less than 4.68%. Does that make sense?
That is true, yeah.
So if our average hold period was 5 days, then in this case, this trade we could take. You wouldn't change that projected movement to recalculate. We're just pushing it because you'll take this because we could see that this is a realistic target to hit within the next 5 days because we're sitting about 4% off of the 15-day. We can go ahead and create our trade plan. We would say, hey, our target is here at the 15-day EMA. That is where we are going to be right. And our stop loss, well, how do you think we're going to determine where we're wrong? This is where we're right. We're looking to trade down to this 15-day. Where would we be wrong?
I think the biggest problem that I see that I wouldn't want to do is adjusting your time frames to justify a contract.
That's correct.
Yeah.
So you wouldn't have adjusted that time frame. But I want to show you this is where, if this was our time frame, yes, we could take this trade. I like based off of where we're trading, determining where we're wrong, okay, if we break above the all-time high, okay? So that's easy. Stop loss at the all-time high. Take profit, stop loss. 780.81 is going to be our stop loss. 734 is going to be our take profit. So now that we've got our take profit and our stop loss pulled up, well, what we do is we'd use these levels. We'd essentially run through this trade. We'd simulate out this trade, and that would give us, well, at which point we're either wrong or right, how much we're going to make or lose. Does that make sense? And then based off of that, we essentially take these numbers, we're gonna punch them into my risk management calculator, which is another tool that I built that I'll give you access to. I'm sure you could tell, like, after trading for almost 8 years, I've created all these ways like that are unique and custom to myself. This risk management calculator is a tool that I totally built on my own. I spent over the last 1.5 years developing this. Once we pull these numbers, we're gonna pop them in here and it's just gonna give us a position size. It's gonna say, hey, buy this amount of these contracts. And it'll manage risk for us, which is great. You gotta learn the basics, but it'll do most of it. So those are like the last 2 pieces of this system that we'd be here all day trying to actually cover. But pulling up the contracts and then, simulating that position out, you'd get your SL and TP, you'd get how much you'd make or lose, you'd pop that in here and it would pull back, or it would essentially give you the position size. Does that make sense? So
how much you're actually going to spend on it, how many contracts?
Yeah, how many to buy. It'll tell you how many contracts to buy based off the maximum purchase quantity and the position size. Okay, does that make sense?
Absolutely.
So at this point, this is just one setup. Again, I have multiple setups so I can continue trading no matter what the charts look like. I can almost find a setup on, I would say 2 out of every 10 charts. which we just went through 100 and only found one. But that's because you only had, this one ATH pullback setup that I went over. Now you should be able to take this strategy. I'll get you in my mentorship group, and you should be able to effectively trade using this very simple, I would say simple process. I know that was a lot to throw at you, and that was like a 30,000 foot view speed run, but I'm
getting the gist of it. I'll go into the mentorship. I'll watch some videos.
Yeah, do you have any questions? I know that was a lot.
Do I have any questions? I'm still confused on the losing money part, where it's like someone else is losing money. If I'm doing like a horribly risky trade or whatever, who has that? Who owns that? Who's trying to sell it beforehand?
That's a good question. So, I mean, you can look at each specific contract, and you can do this on Thinkorswim, you could do this on any other platform. And you could see we've got the volume and the open interest. Now this is gonna tell us what you just asked, exactly. Some people, like literally if there's no volume, that means there's no contracts that have been traded today. No one's traded these contracts. So volume is how many contracts exchanged hands on that given day. Open interest is how many contracts are currently open, how many people are holding them. So you just look at the specific contracts you want to trade, and sometimes you wouldn't even be able to buy because there's no one holding them. There's no one that would sell them to you. Does that make sense?
Yeah.
But on one side or the other, someone is going to be either taking a better or a worse fill price when they get in, or vice versa when they get out. Any other questions? I think
that clears it up.
I really want to check in on your position and see if you ended up blowing
God.
up your entire account or not. But are you feeling more confident? Are you feeling like you can go into trading now, not just gambling, and not just using intuition, but actually using what you learned today to make educated decisions and trade?
Absolutely, definitely, yeah.
Okay. I'll get you in the mentorship group. I will put a link in the description below. If you guys are interested in learning how to trade, you can learn more about my mentorship and apply. First link in the description. So with that said, let's pull up your trading account.
Oh yeah.
Okay.
Can't wait I'm a millionaire. I already know it. I feel it.
All right. Are you ready? Let's see. Let's see what happened.
Yes! Oh no.
You're down 50%. You lost $251.
Who would have guessed?
Well, that's what happens when you gamble. And when you don't have a mentor to teach you how to trade the correct way.
I guess it is.
I'll refund you, by the way.
Oh, I appreciate it.
I should have taught you this. We should have covered all this before you went and gambled. But I did want to show you, that is what will happen to most people. That's why the stats are really against, if you look up how many people fail trading, it's a lot, because this is what happens. They're not properly educated. They don't have a mentor. They don't invest in themselves, their knowledge, their education, and they gamble and they lose 50% of their account. But that's okay. Okay, it's a learning lesson.
If it was a put, I would have been up.
Right? So there you go. Next time, hopefully you'll make a better decision based off of being educated.
I guess.
You want to close this out?
Do I have to close it? Do I have to sell it? Can I just keep it?
So because those contracts expire today, they will expire worthless. So they'll be worth nothing. So yeah, I mean, if you want to try to salvage the rest of your account, the other half of your account, and listen, you might not even be able to get out of these because there was not many people trading them. Ooh. Remember when we got in? But let's see if we can get out of this position and cut our losses.
Fair enough. So what am I gonna do?
Click on that, trade.
Oh,
sell, and
1 cent, $1.
Let's see if you could get out at $2.
124 contracts.
Click review, and let's try to get filled. All right, how do you feel after this experience? I know that was a lot to put you through.
I feel enthralled with knowledge, but disappointed in my performance.
Okay, that's fair. All right, any final words?
Gamble.
Let's get you in the mentorship group. I'll teach you. We'll work together more. If you guys want to join me and Tony, click the link in the description below. With that said, subscribe for more, and we'll see you in the next video. Later.